Hi everybody, in this video I'm going to give a short introduction to trading options using Tesla as an example. This was actually a video requested by one of my viewers. As you can see here, Crystal commented, "Can you show us how to do options trading using Tesla?" And I said I would do a video on this, so here we go. Now the thing is, if you go look up on YouTube how to trade options, there's already plenty of videos showing you how to trade options. If I explain it the same way that everyone else explains it, that's going to be redundant. Not only that, but I feel like a lot of people, they underestimate how overwhelming it can be for people who are new to options to try and understand it. It can be super complicated and hard to understand. I myself had a lot of trouble learning it at first when I was new. Now, options are super risky, so if you're completely new to options, I recommend practicing in a paper account first. Now, what a paper account is it's basically a trading account where you're using pretend money rather than real money. That way you can try things out and do things with options without actually risking losing your real money. And like I said, options can be super risky, so I think it's good to practice first before you do the real thing. So here we are using Tesla as an example. Now let's say we're bullish on Tesla. We think that if they're going to do really well, they're going to sell a bunch of their cars, they're going to come out with new exciting products, new batteries that last longer, all kinds of stuff. And then Tesla will shoot up to the moon. If that's the case, what we can do is buy a call option to potentially amplify our gains. So make sure that options are enabled in your account. There's a button here that says Trade Tesla Options. We're going to buy a call and then pick an expiration date. Let's say something like, I don't know, January 20th, 2023. And then we pick a strike price. Now with strike prices, the lower you go, the more safer it is because the break-even price is lower. The higher you go, the more risky it is because the break-even price that Tesla has to reach is much higher. For example, if we chose a strike price of $1,400, the break-even price is $1,612.75. Right now, Tesla is only at $853, so it has a long way to go before it even reaches this break-even price. And the break-even price is exactly as it sounds. It's the price that Tesla has to reach on expiration date in order for you to make any money. It has to go past this point. If it's below this point, you actually lose money. So like I said, just to keep it safe, I usually like to pick lower strike prices. For example, if we pick something like the $400 strike price, the break-even price is only $926.75. So we're buying a call expiring January 20th, 2023 at the $400 strike price. Continue. Now, as you can see here, it says contracts 100 shares each. So each call option contract, right? It applies to 100 shares each. So if we just put in one contract here and the price is $526.75, however, because this applies to 100 shares each, we need to multiply it by 100. So $526.75 times 100 equals $52,675. This is the cost. So we're paying $52,675 to buy this call option. Expensive, isn't it? It's kind of interesting that I was asked to use Tesla as an example, but honestly, if you're a beginner, you probably don't have that much money. So Tesla would actually be a pretty bad choice if you're a beginner because you have to put up a bunch of money for the call option. Tesla is very expensive right now, so I think if you're newer, you should go with a stock that has a very low price. But then again, if you do that, a lot of them are not very good stocks. It's complicated. But for this video, I'm using Tesla as an example, so it is what it is. So we're paying this much, right? We're paying about $52,000. But how much can we make? So what is this? This is the January 20th, 2023 at the $400 strike price. Okay. So I'm going to my calculator here. Tesla, we're going to January 20th, 2023. And we're buying the $400 strike price right here. Okay. Put in the range. I think I'll go up to 800. That's fine. Whoa, wait a minute. Sorry, I did this wrong. That's better. So, as you can see here, this is the profit loss calculator. And as you can see, if it goes below a certain price, you're going to be losing money. And if it goes up and up and up, you're going to be gaining money. Now, at expiration, for example, if it's around 1380, you're going to make an 86% profit. If it goes down and it goes to about $600, you're going to be at a 62% loss. Like I said, options are super risky, and if it turns out that Tesla does not go up, you might not make any money at all. So, basically, a call option is basically a bet that the stock will go up in price. And if you're wrong, you could lose a lot of money. If you're right, you can make some pretty decent gains. You can even do it in a very risky way too. The way I'm showing it here, where you're buying it at a much later date, at a very low strike price, that's a safer way to do it. This is called a leaps. However, you can play it super risky. Now let's say we choose a expiration date of February 26th, which is very soon, and we choose a strike price of, say, oh, I don't know. Let's choose a strike price of $1,200, just as an example. All right, one contract, limit price 95 cents. 95 cents times 100 equals $95. Now, as you can see, this costs a lot less than the other option we were talking about, right? The other one cost $52,000. This one only costs $95. However, what are the chances that Tesla is going to skyrocket above $1,200 by February 26th? Not likely. However, what if it does? And this is why a lot of people get addicted to like gambling with options. Let's see what the potential profit on this is. So we pick February 26th, right? And we chose the, what is it, 1200? Right, okay. Oh my goodness. As you can see here, if Tesla does not go up as planned, you can lose all of your money, minus 100%. However, let's say it goes to, let's see here, 1320. You're going to make 12,532% gain. Mind-blowing, isn't it? Over 12,000% gain if it goes up high enough. If it goes to, what is this? If it actually goes to 1230, you're going to make a 3,058% gain. So this is why a lot of people like to gamble and buy options that expire very soon and pick a super high strike price. It's risky if it actually does happen and Tesla does skyrocket, they can make a bunch of money. However, if Tesla doesn't, you can lose everything. So it's super risky. So that's a call option. That's when you think the price of Tesla will go up. Now let's talk about if you think Tesla is going to do bad, you think that a whole bunch of other companies are entering the EV market. There's NIO, Alibaba said they might get into EV, there's the Apple car, and you think that Tesla will eventually get knocked off the EV throne and it's going to go down in price by a lot. So go to Tesla options. What you can do is buy a put to bet that Tesla will go down in price. Now this can amplify your gains if Tesla actually does go down in price. So buy, put, again, we pick an expiration date. We can go with, let's see, January 21st, 2022. Now with puts, the higher the strike price, the safer it is. And the lower the strike price, the more riskier it is. Because if you pick a super low strike price, Tesla would have to go down in price by a lot in order for you to actually make a profit. For example, if we chose the, let's see, if we chose the $400 strike price, look at this. The break-even price is $366.15. So Tesla would have to drop by a lot, down past $366.15 in order for you to actually make a profit at expiration. So in order to play it more safe, we can choose a higher strike price, let's say $1,300. So we are buying a put expiring January 21st, 2022, strike price of $1,300, break-even price of $723. One contract that applies to 100 shares each. The price, $576.55 times 100 contracts, 100 shares that is. That's $57,655. If you haven't noticed, the safer plays cost a bunch more money than the risky plays. Now we're paying $57,655 to buy this put. So how much can we make? So this was the January 21st, 2022 at the $1,300. Okay. So January 21st, 2022, 1,300 put right here. Hold on. Go down to 200 here. There we go. As you can see, if you're wrong, you could lose a bunch of money. You could lose your whole account. If Tesla actually ends up going higher and going up and up and up, you can actually lose a lot of money. If Tesla actually does go down like you predicted, and it goes down by a lot, you actually can make substantial gains, like 76% or 80%, 90% if it goes down low enough. However, as you can see here, it would have to go down to $200 for you to make a 90% gain. Options are super risky because, man, if you're right and you predicted the right direction that Tesla stock is going, you can make for good money. But if you're wrong, you could lose everything. So it's super risky. So this was an introduction to call options and put options. They're basically bets you make. A call option is betting that Tesla is going to go up in price or whatever stock that you're buying call options for. you're betting that the stock will go up and up in price by a lot. And a put option is basically betting that the stock price will go down a lot. It will crash. So I hope this helped you understand options a little bit better. If you're completely new, you're either making a bet that the stock will go up by a lot or making a bet that it's going to go down by a lot. Super risky. It can be rewarding if you're right, but I've noticed that it's very hard to predict exactly where stocks are going to go, you know? So it is super risky. And like I said, if you're a beginner, I really suggest practicing with a paper account first before you try the actual real thing. Now, in my account, no, not playlists. Okay. If you're interested in doing spreads like I do, I've already made videos on how to open put credit spreads, how to open call debit spreads, and I even made a video explaining a difference between call options and call debit spreads. These are already in my account. These are videos that I made. If you have spreads enabled and you want to learn about them, you can check these videos out too. So yeah, good luck, guys. And don't get too addicted to the gambling, you know. I think it's better to focus on making consistent long-term gains rather than gambling all your money away. But that's just my 2 cents. Alright, so that was my video explaining an introduction to call and put options. Thanks for watching, and I'll see you guys in my next video. Bye.